Thank you for joining us at xm.com for this Forex Preview video. We'll be looking at the Fed meeting coming up this week. I'm Christina Marujas, and joining me today is investment analyst Mario Sachikiriakou. So, of course, the Fed meeting is the main event this week. Markets have fully priced in a 25 basis points rate cut, and of course, the Fed is expected to deliver that cut, even though one would argue that the U.S. economy is in decent shape, yes?
Indeed, the US economy, the domestic economy is still in a pretty good shape overall. So growth is running around 2%, inflation is below target but not that low, and wages are growing at the fastest pace in a decade. But all of this is not going to stop the Fed from cutting rates this week. And the argument is that the Fed is not reacting to the domestic economy, it's reacting to the global environment. It's trying to make sure that the US does not import a recession from the rest of the world. So the global economy is slowing, that could eventually spill over to the US. We also have the trade war, of course, and it's trying to make sure that all of these risks don't really catch up to the US economy, let's say.
But maybe the most interesting thing out of the Fed meeting will be the dot plot, because it will give us an insight into how the Fed members see interest rates moving in the next 2 to 3 years. That, of course, and Chairman Powell's remarks will essentially set the tone for the market. So what do you think they will signal, and how do you see the dollar performing in the aftermath?
Let's start with the dollar. So I think the initial reaction, the immediate reaction of the decision is going to be lower. So a rate cut is almost fully priced in, but not quite. It's priced in by an 85% probability. That means there's still some slight room for some traders aren't exactly sure whether or not the Fed will cut. That means the dollar could weaken a little bit on the news. However, I do not think that will be sustained, and I think the dollar will end higher overall. And here is my little narrative about that. Recently, we've seen some developments, improve, let's say. So, for example, the US and China have struck a calmer tone on the trade war. They're going to meet in a few weeks to negotiate. At the same time, we've seen the risk of a chaotic Brexit recede. Now, I also think the Fed is going to start paying attention to financial stability risks. Rate cuts usually boost stock markets, and US stock markets are already near record highs. That means that if the US signals that we're going to cut aggressively moving forward, that could push asset prices even further up, and that could start fueling concerns for an asset bubble, for example, which certainly they want to avoid. And last but not least, I think that the latest developments in the Middle East and the spike in oil prices argues for the Fed to be less aggressive. So higher oil prices mean higher inflation, and if you are a major oil producer like the US is, it also means higher growth. So to blend everything together, the Fed will most probably cut rates, but I think they will be hesitant to signal anything or to commit rather to anything further in the coming months. I think the Powell's approach will be something like, we will cross that bridge when we get there, we'll see what happens then, and he will not pre-commit to anything. That could disappoint those looking for clear signals that rates will be cut again in a few months, and therefore that could help the dollar end higher overall, in my view.
I see. Mario, thank you so much for joining in, for your insights, of course, and thank you for watching us at xm.com.